This is your front row seat with any CFO. Welcome to CFO Chat. We're discussing matters Q3 2021, and Abraham Ongenge from Stanbic is in the house. Welcome on set.
Nice to have you, Julian, at our premises.
Thank you so much for this opportunity. Really impressed by your Q3 earnings. Net earnings up about 43% to 5.1 billion shillings. But I have a question in terms of the quality of the earnings. Let's start from deposits. What's happening to your deposit book? Because I noticed a contraction of about 6%.
Yeah, our deposit is really a reflection of our franchise being a universal financial services organization. So we've seen very good increase in our deposit base on the retail and the business and commercial side. But we also do notice that there will be some volatility in our corporate business where some of our customers do find other alternative investments from time to time. And from a point-in-time point of view, we did see some outflow of deposits as we went through the last quarter of quarter three. We do expect that on an average, we want to see increases in our deposits over time.
I think one of the strong points I saw in the numbers is the cost management side, because your expense line, I think, is down by about 6%. Yeah. How is that going?
Yeah, it is a reflection of our philosophy around we want to extract efficiencies through building digital capabilities, reduce the cost to serve for our customers by reducing our cost of operations, but as well invest in terms of ensuring that our solutions meet our client needs. So we've almost saved to invest, and it's quite pleasing to see that that's kind of paying off and also creating a room for us to invest further.
So going back to your balance sheet, when you look at the evolution of the loan book vis-a-vis the deposits, one of the things which I noticed is that your loan book is up about 11%. And if you look at now the contraction in deposits, what that means is that your loan to deposit ratio has gone up relatively significantly. Was that a strategic move, or is that just happenings based on the market developments?
We do monitor our loan to deposit ratio quite closely, but we place a lot of importance in ensuring that our lending book is funded and matched within the various tenors. That would mean that we would try as much as possible to optimize our cost of funding by looking at other alternative means of funding, while as well trying to invest into a lending book to create growth in our client franchise. So I'm not necessarily worried about the loan to deposit ratio, because I do think we have adequate liquidity at the right tenors to drive the growth we want to see.
And which sectors are driving now the expansion of your loan book?
We've seen some pockets of recovery in manufacturing. We've seen pockets of recovery in agriculture, and we've also seen some pockets of recovery in trade. Trade is particularly interesting for us because it does allow us to have short-term facilities for our clients to enable goods and trade to happen across Africa, and also through our partnership with our Chinese clients.
Your asset quality in the single digits is quite impressive, given the sort of macroeconomic environment you're operating in. I think your NPL is at about 9%. What's driving these recoveries?
I think our strategic approach around how we resolve distressed assets has paid off. And our strategy was actually to partner to find win-win solutions for our clients. That means that we were able to resolve some of the distressed assets by still ensuring that those businesses continue to go on as a going concern. We've seen very good successes there, where we've gotten equity partners for some of our clients. We've been able to restructure some of our clients and move them into a performing basis. And we've also tightened our collection strategies going forward to kind of mitigate further deterioration of asset quality. I have to say the industry has suffered a little bit because of the nature of how we've managed the pandemic around closures here and then. It is something we are continuing to be cautious about, but we are cautiously optimistic that this will resolve as we go into 2022 and 2023.
Still related to that, is there a proportion of your loan book which is still under the COVID-19 moratoria relief which was granted? I mean, we understand the period which was given for the directive lapsed, I think, at the start of January, but banks then were told to continue on a case-by-case basis. So how does that proportion look like?
We are pleased that we have resolved all of the moratoria that we had granted in the year 2020. We are cognizant of the government directive to look at accommodation for lending below 5 million. And we are in discussion with some of our customers on that. But we are actually pleased that about 89% of our book is current and performing, so our customers are meeting their obligations. About 2% of our book is between, you'd say, 30 to 90 days in arrears, and then 9% non-performing. So quite an improved book. The same period in 2020, 86% of our book was performing. So the general trend is that a big chunk of our book now has moved into performing.
Going back to the profit and loss, one of the things which stood out for me, considering the sort of quantum leap I saw in your loan book, I was really surprised by what looked like a very soft growth in your interest income at about just 2%. Why that sort of disparity, if I could call it?
The loan book benefits from what we would call annuity type income. You would recall in the first quarter of 2021, our loan book actually had declined by about 3%. When we are looking at the third quarter, we are seeing an 11%. So it does tell you that a lot of that growth has come through on the second half. It ties very well with what we have seen in Kenya, where economy has started kind of opening from the second half, and we are seeing that reflecting in how we are now converting our pipelines going forward. So we expect that the base you see in terms of growth would create a good base for us to continue growing in 2022.
Let's talk about product diversification. Unai, how is it doing?
Unai is a particularly interesting innovation from Stanbic Bank. It does allow our customers to digitally transact, to do cash in, cash out payments across 20 countries. It does allow capabilities for some of our partners to do disbursements across many clients. It does allow cost optimization in terms of cost of transferring money in between friends, in between businesses. We are doing pilot tests in markets in Nakuru, in markets in Nanyuki, and the reception is good. And we do foresee that we will do a formal launch as we go towards the end of this year, early next year.
I see. And still on the side of products, Stanbic is a heavy player when it comes to the transaction side of this market. And we have seen a bit of activity lately. What's your pipeline looking like? Just indicative.
We've closed key investment deals towards the second half of the year. We are seeing a very healthy pipeline with our clients and a lot of appetite to go back into markets. As you'd understand, our subsidiary company, SBG Securities, is currently supporting clients with the MTN shares in Uganda. So the market is looking up and our pipeline is healthy.
Given the sort of results you have put out, I'm sure your shareholders are wondering, no interim dividend for that matter.
I have to reflect that as Stanbic and as our holding company, Stanbic Holdings PLC, we were among the first to actually declare an interim dividend, 1.7 shillings per share in August. At that time, there was still some cautious optimism around vaccinations, but we were bold enough to return something to our shareholders. That does indicate that we do have appetite to continue to return value to our shareholders through dividend. Our share has performed quite well in the second quarter, I think a 14% increase. So that's another way with which we generate value for our shareholders.
Speaking about the risk profile out here in the COVID environment, just walk us through how you are recalibrating your stance on the loan loss provision, and why that's a very important point is because we are seeing a very mixed bag in the market when you look at banking results. Some are aggressively unwinding, some are still ramping up.
We do go through a rigorous process around setting risk appetite, but we also do realize that we are part of the Kenyan economy, and we do need in a way to support the Kenyan economy. So we've kind of split our thinking around how we go about loan loss provisioning and how we set our strategies on supporting our customers into three. One is that for the customers who we have deep understanding of their business, we have deep understanding of what they're trying to do, we will create enough capability to serve them in the normal manner. There would be customers who would require some level of support, but with good business prospects. For those ones, we will look at various credit mitigation strategies such as guarantee schemes and risk sharing with some of the partners we have. And then there is also the piece around our customers or the population of the economy which requires help to lift them up post-COVID. And through our foundation, we will be doing that through grant funding. We have gone through the first round of grant funding, and we've seen over 586 micro and medium-sized enterprises applying. We have completed awarding about 7 winners from that exercise. We'll be doing that on a quarterly basis. So split into three. The customers we know, we continue to serve them. The customers who just need a little bit of assistance, and in the markets where we do need to understand, we go through credit mitigation schemes. And then the third, for customers who we do need to support to get them to be bankable, we do that through grant funding.
Just going back to the numbers, one of the things which stood out for me and forgotten about it was commissions from loans and advances. It's down 15%. What's happening on that line?
Yeah, I think it's a mixed bag on this. And during COVID, what did happen is that as a banking sector, we did waive some of the digital banking fees, and that shifted a lot of our customers into our digital channels. We have extended these waivers in 2021. What it means is that on the fee and commission side, you'll see a dip as we kind of normalize through scale. But the positive is also true that our cost to serve has also reduced because we now do not need to utilize a lot of brick and mortar to serve our customers. So it's a mixed bag, largely on account of the fact that we now have a much more cost-optimal digital banking service. Having said that, we have seen a good rebound on fees and commissions, especially on trade finance, as economies have opened, and therefore a lot of the intra-trade across Africa, across the Middle East, across China has started to pick up.
I see. Let's wrap up this conversation. How is the South Sudan business doing?
The South Sudan business has remained quite resilient. We do consider South Sudan as hyperinflation, and we continue to serve corporate customers and the retail people who then are in part of the corporate customers ecosystem. Our approach in South Sudan has largely been a transactional business. and foreign currency intermediation. South Sudan remains profitable as a standalone business. We do see that part of the actions, such as the revitalized peace agreement, kind of shaping up, and we foresee a much more stable operating environment in South Sudan.
If I recall well, I could be wrong, Unai came in and we saw a bit of a raiding of talent by Stanbic Bank. When I look at the staff costs, I didn't seem to see something that I would say is quite popping out in terms of how that has changed. How do you assess the extent to which you have controlled that line?
Staff costs, if you kind of look at growth in staff costs, you can see our growth in staff costs is about 12%. You would say if you're running a business normally, that growth should almost be 6%, so almost an inflationary adjustment. So it tells you we've done something different. And COVID allowed us as a bank to reflect on our strategy and refresh our strategy. That resulted in us reorganizing ourselves to be client-centric and also focusing ourselves into various solutions that we needed to offer. It did require that we enhance the skill set within the bank, largely on aspects you'd believe as behavioral economists, so that we understand our customers deeper, data science, so that we are able to leverage on data to pick up pockets of opportunity and also pick up various insights that are happening in the market. Technology, to allow us to build the necessary technology in-house to support the various capabilities we want to show our customers. So there is a slight uptick above inflation that then reflects the skills we are building in making us a future-ready organization.
There's a lot of concern out here that going into an election cycle, and we of course still have COVID here, that banks will continue piling their liquidity on the fixed income side. We're seeing government is giving more attractive yields. We're seeing very attractive corporate issuances.
Our experience has actually been contrary. If you look at our balance sheet, we've actually reduced our investment in government securities and placed a lot of that into the client franchise. From the time I have been in the Kenyan market serving as a CFO, while elections have always created tension, they've never really created such a big tension that it hurts the growth of the economy. So I'm actually optimistic that Kenya will go through this process, respecting the healthy democracy that we have as a country.
But now that you've said that, Abraham, there's been a lot of effort to de-risk lending to the micro, small, and medium-sized segment of the economy. How is your book on that side looking like?
The proportion of that book is not as big for Stanbic Bank, but it's showing good signs. A lot of what we do in terms of supporting the MSMEs is short-term working capital type financing, which then allows them to kind of apply it into the business and then bring back the money and borrow and borrow again. Now, as I said, we do believe that there are some of the MSMEs who require support to actually move into the bankable space. And our foundation will be critical in doing that. We will be looking at putting almost about $10 million over time in grant funding type. And we do hope that with the support we are giving them in terms of training, in terms of financial management, in terms of digital skills, we should be able to build sustainable MSMEs that then move into the formal banking sector.
Abraham Ongenge, thank you so much for your time.